People were live.
Oh, now
I think there's absolutely something to it. It's again something incentive.
What do you got for that?
Why?
Well, proceed.
So committee, it's not Friday, just because I said you might get out early tomorrow and get a snow day. This is starting to feel like Friday after. No snow day.
Is it? Oh, yeah, the ceiling.
Okay, this is what number? The bill we went over, is it 282? Yeah. And as I went back over the notes I took, it looked like there were thresholds that were different than the federal thresholds, and things that might cause the tax department some consternation and maybe tax filers. So I'm wondering, just have Patrick come back and talk to us some more about it. Now that we had a little bit of time to digest what it is, talk about, what we're looking at for amounts and what we might be able to do. And so Patrick, and there was it didn't comply with our capital gains for farms and businesses. I remember, yeah, a note about that. So the floor is yours. Yeah.
Okay, so Patrick Titterton, Joint Fiscal Office. There should be a one-sheeter with some information up on your website, so sharing it. I was just going to walk through a few different things, and then Madam Chair, you've asked for a couple of different scenarios to estimate. So the first thing I just wanted to sort of talk about is sort of who's paying this tax, what does the income distribution look like, and how much are people in different income brackets really contributing towards it. So what we do have is the IRS does publish state by state statistics on some of these provisions. So was able to go, it's from 22 because they're usually on a couple of year lag in terms of what they publish, basically when they finalize things. And so in Vermont, there's about 12,000 people who exceed those thresholds, have this investment income, and are paying the federal net investment income tax. You can see that a couple of things that kind of jumped out to me when looking at this is this 200 to 500 range comprises about 72% of people in Vermont who are paying this tax, the federal tax. And what they're paying is about 21% of receipts that the feds are receiving from Vermonters.
So I think the tax started at income of 200,000. So how do we pick up the 100 to 200?
Yeah, so for married filing separately, and I believe also for singles, they might be below that threshold.
Okay.
So yeah,
Getting singles filing jointly.
yeah.
Fine. So if we move the 200 up to today's dollars, we would lose the bulk of our payers.
Yeah, I mean, if you
Revenue, because look at the revenue in the bottom right.
Yeah.
56% of it is for people who earning over $1 million.
Yeah.
Yeah, so 72% of the people in that 200, 500 range are contributing about 21% of total receipts for this tax day. But you can see that 970 people who are over $1 million in adjusted gross income, they make up about 8% of the population, but they're paying over half of what the federal government was receiving from Vermont. If you combine that with the 500 to $1 million, it's about 70, 79, almost 80% of the receipts are coming from those households or filers who are above 500,000. So that's sort of the income distribution and how much people are actually contributing towards this tax thing. When you had me and Jake Feldman with the tax department, he had brought up Oakwork, or maybe something to think about that lives in the personal income tax world, sort of a separate parallel world. So Vermont does have something called the capital gains exclusion. And how that works is if you have taxable income, you may reduce your taxable income by up to $5,000, applying it towards capital gains income that you're claiming, which capital gains is an important part of the NIIT because that comprises about 58% of the income that the feds are classifying as that investment income for that tax. So yeah, the capital gains exclusion is something already in statute. It lives in the personal income tax world. We do treat capital gains as regular income that you are filling out your 1040 form that you file that Vermont uses as a starting point. And this is something included in the tax expenditure report. So for fiscal year 26, the forecasted tax expenditure for that exclusion was about $18 million. So not insignificant, and it's a relatively large tax expenditure in the personal income tax world. And I think what Jake was kind of talking to you about is something for you to think about is whether having this exclusion and then in addition imposing this investment income tax is sort of consistent because you're giving a tax break on one side, but you're increasing the taxes on it on the other side.
Okay.
I think if there are any other sort of questions to think about that.
Committee.
Can I just ask you more about that? So the capital gains exclusion, it is the same income stream that is taxed under the NIIT.
So yeah, so
How do you say that?
I don't know. Some people I've heard call it NIT.
No,
I don't know if
okay,
people know what I'm talking about.
okay, yeah, I wouldn't.
It's also kind of a mouthful to say net investment income tax.
Yeah,
NIT, yeah.
yeah. Oh, well, that's not good. Anyway, is it the same income?
Okay, so I guess taking a quick step back. So personal income tax, all of the income that is being included in this investment income tax, all of that income is just being treated like regular income. It goes through, you have your standard deduction, you get your credits, it runs through the income bracket schedule. So adding this new tax is almost kind of like a surcharge, but specifically on that investment type income, of which capital gains is part of.
Right, but that investment type income is not, is that included in personal income?
Yeah, it's treated like regular income.
It is, okay. And then the exclusion, that's an exclusion from personal income.
That exclusion, yes, exactly. And that exclusion allows you to reduce some of those capital gains income that you had.
Okay,
When
and
calculating your personal,
that's a state exclusion.
it's a state exclusion.
Okay. And is there a federal exclusion too for some of that income or not?
That's a good question. I don't believe so, but I
Okay.
should probably be certain before I answer.
Yeah.
Okay,
The first 5,000, and he had said something about business or farm income, but the first 5,000 of capital gains when you sell something is counted as personal income, right? Under Vermont law.
it's excluded from personal income.
No, it's counted as rather than as capital gains.
Yeah, so the capital gains, the capital gains are treated as regular income, but there's this exclusion that allows you to apply it towards that type of regular income on your personal income tax return. So it's an exclusion for a specific type of income, if that makes sense.
Sort of. So can I just give you a simple, if I might, I'm trying to figure this out. So if you make I guess $250,000, make $250,000, and then you make $50,000 in capital gains, like 250 of earned income, quote unquote, from your job.
Yeah.
And then 50,000 in capital gains. This exclusion, the Vermont capital gains exclusion, allows you to so that's $300,000 of
Yes.
income. The capital gains exclusion allows you to subtract 5,000 from that $50,000 in capital gains. So then it would be 295,000.
Yeah, you have it.
Is that correct?
You
Okay.
Oh, okay, so what happens to the 5,000? It's just not taxed.
It's just not taxed.
Correct.
Yeah.
Okay, so that's all right.
Okay.
But we're talking 5,000 here, right?
That's the cap. That's the most that you can, it's a little bit more before that, but that's the most that you can exclude from your reported income.
Okay, so it's not taxed in Vermont. It is taxed federally.
Now so not quite.
Okay.
This is on when you're filling out your Vermont form,
Yeah,
and we'll use the same example. You've got 250,000 in wages, 50,000 in capital gains. And this is your Vermont return. This is what you're reporting to Vermont. That exclusion allows you
so I
to
write
reduce the
300 down and then I subtract out the $5,000.
yes, assuming you have enough capital gains to apply it to.
Right.
Yes, yeah.
Well, if I only have 5,000 in capital gains, I didn't get very much from my Mickey Mantle card. There it is, Mickey Mantle. It's a fake.
It's a fake, it's a replicate.
It's a new antique, new old. Okay, if I get 5,000, if I have 7,000, I don't pay tax on 5,000 of that, and it's any kind of capital gains.
I believe there is a holding requirement of 3 years. I can double check.
Okay, but I have to hold the investment for 3 years. I can't.
And the total tax expenditure for that is this year is forecast to be 18 million. Is that what the 18.3 is? Is that
Yes,
in millions?
yes, and that's a tax
Okay.
expenditure, so it's
That's in capital.
revenue we're not collecting.
Right, revenue we're not collecting.
And I have a feeling, yeah, all right.
So to Jake's question that you referenced at the start of this, though, my understanding is capital gains is just one piece of NIIT incomes. There's also investment interest, and dividends, passive income, rental royalties, non-qualified annuities, and what little I know about wealth. It's those other four that I'm betting the top million, the 56.1% are probably regularly drawn because capital gains is the triggering of a sale, which is those one-time high income years things, where these other ones are more continual. Passive income, rent, royalties, annuities.
Yeah, and that actually brings up something that's important to think about with this tax. So, about a little less than 60% of the income that is captured by the NIIT is from capital gains. And when you start thinking about timing of sales, right? So that's something that an investor or taxpayer is going to have the most control over when they do it. Because they could sell, they've got a stock portfolio, they can always sell just below the threshold that you're setting for them. But that might not be as true if they're selling a business they've owned for 30 years, right? Because it's hard to sell that in pieces.
Change residency that year to avoid the capital gains tax in Vermont, right? If we're selling an asset.
Not if you're selling a physical asset though, right? Like you sell property here and you get gains on it.
Yeah, so like if you have a house in another state that you sell, you are typically going to be required to file a non-resident return in that state. And then Vermont will allow for a credit for taxes paid to another state on your resident return if you're filing as a resident. And it'd be a similar situation if you were living out of state and did the inverse, you file a non-resident return in your state.
But the capital gain would happen in Vermont, be taxed in Vermont. You might
Yeah.
get a credit for it. In
So we did talk to the tax department about how some of that apportionment would work. And generally speaking, and this seems to be how it works in Minnesota, it's all about the domicile of the taxpayer. So if you're in Vermont and you sell something out of state, you're going to be paying tax in Vermont because essentially you're receiving the income in Vermont, right?
Oh,
But if
Yeah.
you live in Florida and you have a home in Florida and you know you're going to be selling something you own that's located in Michigan or somewhere, even Vermont. You stay 6 months and 5 days in Florida, declare it your legal residence, sell it. I don't know what they do with capital gains in Florida, but they don't have an income tax. They might have a very high capital gains tax.
I mean, if you were living in Florida for 6 months in a day, but you're domiciled in Vermont the other ones, you're still gonna be having to file a Vermont non-resident return.
If I'm living in Florida, I have a second home here. Usually I live here for 8 months. But this year I'm only gonna live here for 5.5 months. Because I'm planning on selling something I'm gonna make a lot of money off. And we're talking about folks that have resources. So for this year or next year, I spend 6.5 months in Florida. I file it as my legal residence. I am a resident of Florida when I sell this. Why would I wouldn't file with Vermont, right? Unless maybe if the business, we should have the tax, I mean, if the business were in Vermont, maybe. But if the business is in Michigan, I don't know, but this, we don't need to worry about this. That's why we pay the tax department.
But I think Patrick is the point, or his point is that you would have to file a non-resident claim here, and that then you would have to pay some.
Kind of get a portion based on
Yeah.
the time that you're.
If I don't live,
Yes,
this is not my legal
portion.
residence, but I come here to ski and I own a home here.
If the asset was Vermont domiciled,
It's more about the domicile of the taxpayer.
yeah.
can I reframe your question? Because I like your
Yeah.
question. I'm really trying to understand. Say I lived in Vermont my whole life. 55, 60 years old, and I'm ready to exit. I want to cash out. So I'm going to sell either
No.
my house, my property. I got a business. Okay, I got the cold hollow side of it. My uncle Eric, he stayed in Vermont. Let's say he's about ready to sell his business that he built up his whole life. If he relocates, if he lives in Florida for 6 months in a year for a couple of years, and he sells that business that's located in Vermont, would he still have to pay any increased Vermont NIIT tax?
The question seems a little easier to me in the personal income tax world. Because in that instance, you would be required to file your non-resident return if you were not in state for long enough. And one thing else to remember, so if you sell your business in December of 24 and you move January of 25, when you file your taxes in April, it's going to be on the tax year 24, right? So in your residency during that time period would have been in Vermont.
The same scenario, but let's say that business was located in New York, but he lived in Vermont all his life. He owns that business in New York, but now he relocates to Florida. The assets in New York, he's now a Florida resident. Would he have to pay when he sells that multi-million-dollar capital gains, the Vermont NIIT tax?
These are starting to become questions I often ask for reassurance from Will Baker.
Yeah, I
from the
think
tax
we're
department.
going to have the attorneys from the tax department talk to us about.
But it's an important question,
It is important.
because this is where behavior will align.
Right, but I also think, and I think I'm hearing this correctly, so like if you live in Vermont for 4 months of the year and you live in Florida for 8 months of the year and you have a capital gain, you have income of any kind, you have to file a non-resident file in Vermont and pay the proportion of the time you lived for 4 months of that income. So if you make $100,000 and let's say it's evenly split nicely, 40% of it would be income in Vermont no, I did the math wrong.
Yeah.
A third of it would be income in Vermont and 2/3 of it would be income in Florida.
But if they just move to Florida and don't even keep the 4 months here, do they still avoid that Vermont specific NIIT?
For selling something that was in Vermont, that's a property in Vermont.
I think we're gonna talk to the
Yeah,
tax
but there are
department.
other like property transfer.
Yeah,
that.
because this did a
Good tax.
lot, came up during COVID. And it comes up with working remotely. If you were a Massachusetts resident and you were working in Massachusetts remotely,
Yeah, I remember that
but you
conversation.
moved to Vermont, then then it got apportioned. You owed, because your legal residence was Massachusetts and you were just hiding out here for a few months.
Question, does it get done proportionally based on the amount of time you spent each place during the year?
Right,
Or if you had a situation in which you worked in Vermont, working on a drugstore counter for 4 months, and then you moved to Florida and you became CEO of a company in which you made a bunch of money in Florida, you made very little in Vermont. Do you apportion it on the basis of the number of months you
That's
lived in a
what-
year?
we're going to have the.
Yeah, I think there are a lot of nuances
Yeah.
here that,
In Massachusetts, there are a lot of people that were working in Massachusetts,
Yeah.
but live in New Hampshire.
yes.
And during COVID,
Try to call.
they were not
Yes.
going to Massachusetts. They were working from home in New Hampshire. And Massachusetts was trying to pass a law that would cause them to have to pay tax in
On that.
Massachusetts.
Well, I know for a number of years
Said.
Yes.
that I've experienced working
Never
in
mind.
Massachusetts, for a
So,
Massachusetts employer and living in Vermont. I always paid an income tax to Massachusetts for the period of time that I was there.
right,
But then I remember when I spent a couple of years working in overseas, I still paid Vermont income tax
yes.
for the entirety of that period.
If you are an American citizen, my son, who hasn't earned a cent in this country,
Yeah.
in 20 years, he lives in Canada,
Mhm.
has to file American income tax forms. And that was one reason his father-in-law, who's a tax attorney, advised that they not get dual citizenship for their kids, because unless the kids decided they were going to live here, if they were American citizens, they have to file tax forms every year, even if they have never earned anything.
So
So,
if we're thinking of looking at a variety of things as new income tax
we'll get this.
issues, this is clearly something which we're gonna need some advice.
But to a point that Martine is trying to make, do you want to make that or you want? No, go ahead. The chart that you have there, the federal net income, that's current law. That
Yes.
happens already.
Right,
The next box is current law. That happens
Right.
already. So these questions have already been,
so
Answer.
that's why we're going to have the
It's
tax
just-
department tell us.
it's
what
not
the
like a
answer
whole
is.
new thing.
Yeah,
It's-
okay.
Okay.
I understand.
Okay,
So
the proposal
But-
is that we move, that we set up that Vermont tax, that there's a Vermont state tax. Right now, Vermont doesn't tax this, right? And the proposal is that we would.
You're adding tax.
isn't there another box down below?
Yeah, I have another
Yeah.
box.
Can we go for that? Yeah.
And we'll just real quick comment about the federal version of the tax. One nice thing for them is they don't have to worry about apportionment, right? So I have this estimate done 4 different ways. One is on the expanded version of the NIIT. So we're talking about proceeds tax. Now it's essentially just the same thing with a different name. But it's expanded, so it has a few different additions that Kirby walked you all through the other day. And so as it's proposed in the bill in its current form, we're estimating this to be about just shy of $60 million additional revenue to the state. And I'm just highlighting there, this is the same, this is based on the same income thresholds that the federal version is done on. So if you remember the top box, that's the 12,000 individuals we estimate would be paying this tax. And so still on the platform of the expanded version with the additional add-ins, but increasing that income threshold to about 500,000. That would reduce the number of taxpayers down to about 3,200, and we'd estimate about $47 million in additional revenue. And then the last two are, again, the first one is based on the federal income thresholds. The second one is based on the 500,000 income threshold. But these do not include some of those additional add-ons that the federal version of the tax does not have.
Okay, so basically, if we did the wealth proceeds tax with the federal income thresholds, that's the 200,000, which people are used to pay, then we would get $48.649 million out. For this one is the bill proposes to send it to school construction, right?
That's what I thought, and then Tanya said today only the second home tax would go to.
Second home taxes,
The bill, that bill says school construction.
Yeah, no, that's what I thought.
I believe, if I remember correctly, there was intent language suggesting that, but there was no mechanism to like officially dedicate it to a special fund
Okay.
for a specific use.
there is a special fund in 73, there's no money.
I don't think there was any.
20 pages of verbiage, but no money. Okay, but we will have 50 million, give or take 5 million.
Well,
Um,
is it 60 million?
As the bill's currently drafted, that's that 59.6 that I have highlighted there.
Yeah.
Yeah.
that's because. Wait, because that picked up some things or had
Additional stuff.
additional stuff. And I'm thinking that as close as, if all people have to do is file the same form with the state that they file with the feds, it'll be a lot easier. If you have to go back and recalculate because there's a different income threshold or a different percentage, but the simpler we can make it, the easier it would be.
And I'll just throw out, the only other state that has an income, like a state specific income like this is Minnesota, and they do adhere more to the federal definitions for income that's included.
It's just on $1 million or more than $1 million.
$1 million of investment income, so that's not even including your salary or anything else you might be earning income.
All right,
Go first.
Patrick, do you have a sense of how other states are responding to the federal tax cuts at all? Is there like a general? You probably don't, but I thought I would ask, I was just curious.
Yeah, no, so there are definitely some states that have been decoupling certain specific provisions. One that comes to mind, Michigan just decoupled in a few areas relating to corporate income taxes. I think Alabama also recently did some decoupling on a few provisions related to corporate income taxes. And there's a lot of other states that are, currently in their legislative process now that are taking testimony and thinking over, can this stuff that's flowing through to us, how does that fit in the context of our ability to maintain our budget, right? So there are states, and I've predominantly seen a lot of action being taken in the corporate, specifically income tax world. However, part of the reason for that is a lot of states are linked up to a point of like the definition of what, remember the charts I came in with a month ago? So there's the sort of above the line, below the line discussion. A lot of the, no tax on tips, overtime exemptions, those are happening in ways that don't directly affect state personal income taxes. There are a few that it does. Some states link up to taxable income rather than adjusted gross income like departments. But yes, there have been other states that are making changes based on, expected impacts from each other.
we aren't losing a huge amount of money with the income tax change, as I remember.
Well, we are working on updating those estimates, which you all saw. We've been getting more information, which has definitely helped us get a better understanding of sort of scope, I guess we'll say.
Okay, well, we should know that too.
Yes, it's work in
Because
progress.
it looked
should be
like
considered.
we weren't, but I suppose it's a question for Jake, and the tax department, do we know how much money we're losing? Or are we?
Jennifer has been working with the tax department
Okay.
to sort of update those estimates with the better information that we have.
Okay, because it's the personal income tax that is our big.
Personal income tax, we, for the bill and our scoring, we seem to be largely insulated from the changes that were made. It's really more, in the corporate income tax world where we are definitely seeing some stuff that's been flowed through.
Okay. Well, as soon as you got a handle on that.
Yeah, and we should be done with the update soon, so I can come talk to you about that.
Yeah.
Yeah.
So an important piece for this, if slash when this conversation goes forward, I'd like to really crystallize is because you cautioned twice, so did Jay, capital gains is very strategic when it wealth can decide when to incur those things, what the residency is. They talk to wealth advisors. But when it comes to NIIT, there are a lot of other types of income that aren't the same as capital gains, which is again, investment interest and dividends, passive income, you mentioned royalties, non-qualified annuities, the continual flow of capital to be wealthy continuously. Because all I hear too is that our really high income earners in Vermont, large number of them are just for 1 or 2 years when they have those events, so to speak. So my question will be, if this goes forward, is can we discriminate on the incur of those types of incomes and segregate capital gains out and only look at the other 4 types of NIIT incomes that are more continual, incremental, the dividends, non-qualified annuities, rentals and royalties, or the way that we would get this with feds, if there's no discrimination between those types of categories?
Just to make sure I'm understanding right, are you saying, if you were to do a wealth proceeds tax, but not have that apply to capital gains?
Correct.
I mean, we have a way we could estimate it, for sure, because, we know it's about 58% of this income is capital gains, so if we can back that out. The line items of, if it's an annuity income or interest income, that I'm not sure about.
That'd be a question of the tax department if they could logistically implement that.
Well, maybe.
Yeah.
Right. I mean, you do see that, Minnesota's doing it, right?
That's one state though.
That's one
That
state.
gives me some
Doing
policy.
what, the whole thing? Not-
Yeah, they have this type of tax,
Really.
but they're still, it's still pretty new, so we're sort of waiting to hear a little bit more about how the administration of it's going. They don't have enough information yet to really tell us if they think it's
This is new.
being effectively administered,
Mhm.
or maybe that's a bad way of phrasing it, but how things are going.
Yeah.
Okay.
Yeah, and I guess just to comment, everything that is being included in this wealth proceeds tax, Vermont does already tax on in the personal income tax world. This is effectively, I guess you can kind of think of it like a surcharge on this type of income
Okay,
with extra steps.
all right. That's an interesting way to see it. Okay, well, we will ask the tax department, probably Jake, to come over and talk to us about. Not gonna spend time, but if you sell something in Florida. Cause I'm not about to do that. That's why I haven't.
That's all cap.
We'll take care of
Yeah,
it.
but there's lots of other incomes in this.
So we will talk about that.
Potentially,
Tell
I know
them
he's coming to testify before us,
the capital gains and ladies
not as often.
and how could they administer it? And if we made changes, could they administer it? Okay.
And again, just something sort of philosophical for you all. I know that there's no enabling language dedicating this for school construction. But generally speaking, when you're talking about, and I'm not saying that this is school construction, but something where there's going to be a consistent need for revenue to fund.
Need some.
Generally, if it's consistent and sort of predictable, broader base taxes are usually good. And generally narrower base taxes can be more volatile.
If the economy crashes, this will probably crash with it. And yeah, and that we'll have to look at. How would that fund work if we are on the hook to make payments, or is this a one-time subsidy to the school to pay off? Because what we were told is we can't pledge the full faith and credit. And that the treasurer's office was asking us to say schools could bond through the municipal bond bank. And as we had the money, we would give them a grant to pay it down. I think as far as that discussion got, but there were no commitments. And I think this, yeah, that would be, what are we on the hook for? Is it making the bond payments? Or is it we'll just pay down whatever we can come up with this year, we'll pay down the total amount and appropriate it to the, yeah, or we'll give each school a grant proportionate out, so.
And if I'm, oh, sorry.
Yeah.
I just, if I may add quickly, what I just said is not a comment on the validity of this tax type for
Right.
that purpose. It's purely something you should make sure you're honestly always considering when
Yep.
thinking about taxes and
It's
the suitability question.
It's better we hear it from you than 3 years from now when something really bad happens. So I think we've got enough to work with.
Something you just said, and I'd love to know if Senator Gulick has a different perspective from her work on the school construction task force. I've heard the treasurer express and the previous one not wanting to pledge the full faith and credit of the state for school construction aid. I'm under the impression he used to, and was what lowered the interest rates for
Yes.
schools. And so I want to question that assumption, because pledging the full faith and credit of the state of Vermont to get a lower interest rate to build schools, they're still going to pay off the schools, but at a lower interest rate. It seems to be like exactly what I want us to do. Plus, now they're coming to us that they've got so much cash, they want more flexibility to use that cash for other investments. I'm just wondering if we should question that policy, and I don't know if that came up on your task force efforts.
It definitely did come up, but I think you're probably better poised to answer the historical question.
My first year here, I was on institutions, and it was the year we ended
Oh,
school construction. I
Okay.
remember that one. Because we had used up our bonding capacity. And I know,
Different time, right?
Yeah, 2007.
but we had to approve the bonds.
Mhm.
But when we were coming out of that era, we were building schools that we were building out for the baby boom. Those schools are now 30, 40, 50 years old. The other ones are 150 years old and made of brick. Some of them were better constructed than others. And they've been through their lifespan. So now we're talking major maintenance, like roofs, which cost thousands of dollars. And
I don't know much, but if we go forward with the grand plan with consolidation, I think it'll make that hill a lot easier to swallow if it's coupled with pathways to build new schools strategically at optimal locations that the kids would benefit. So it
we'll
just seems to
expand a
be
present one.
part of the discussion.
Yeah, or renovate or expand.
Yeah, renovate what you've got. Has anyone been, I finally got a tour of Barrytown schools in the basement. I walked through the halls. There was just one huge open classroom, and now they've put up things like filing cabinets to divide out, but it's all, you can hear every class in every, it was interesting. And U-32 was that way. They were both built at the same time.
Late 60s, early
Yeah.
70s, open classroom was
Yeah,
it was a
the thing.
trend at the time. Yeah.
And it's fallen out of use, but
Yeah, they
these schools could
pulled out
use some
walls.
help to build them all.
It wasn't a good idea.
Yeah, it's loud.
Yeah.
Yeah, it's very loud. Any kid that is easily distracted is gonna have a problem.
The walls at the Macy's campus don't go all the way to the ceiling.
That's this
So
one.
You've got like an open
Yeah.
Went to a high school lecture.
noise,
Yep.
it's really problematic.
So anyway,
Points of anxiety.
we need, yeah, so we will talk to the treasurer's office, I think, about. the
I think that's a great, I think speaking with the treasurer's office is a great idea. They were very helpful through the iterations of school construction, task force committees, et cetera. But if we do want to expand our knowledge of school construction and the issues that are facing that landscape, Bob Donahue is a great person.
We had him in last year, didn't we?
We did, but we
Yeah.
could have him again.
Okay,
He was very narrowly focused that day and you could just, if
Well-
the AOE would let him come in and just like speak to us in general, it'd be really
Okay.
helpful.
well, I think. I'm
We have
looking at
time.
time, if
We have
this bill's gonna get out. And before we dedicate it to school construction, I think we need to know if it's viable.
Mhm.
And, I have a feeling we might have to fight to hold on to the money before it gets out of here. But it's expanding on a present program. And I think it would be more acceptable to those we're taxing if we did dedicate it to something like school construction. Or maybe transportation, which is another big goal.
Funding school construction, one thing, but the pledging the full faith of the state to get lower interest rates, that's not
no,
necessarily
we're not doing
funding.
that.
The school's still funded, but they just get a bit more favorable terms.
Yeah, but they get that, but they'll get that going through the municipal bond bank,
State?
is what I.
Okay.
Yeah, the bond-
The state, that's why everybody,
Same.
Beth Pierce was so focused on having a AAA bond rating.
Enough.
Because, and that was the deal, if we spent down all the reserves in the ed fund. Then that would probably immediately affect our bond rating. Because that's our savings account they want us to have. So we won't default. And that's why there are funds sitting around here that don't get touched, except in an emergency, so.
And we have Michael gone in, right, from the bond
Yes.
bank?
Yeah.
Last year.
And we will have, yeah, and we will talk to them, and then we will think on where that goes and maybe talk to some of our counterparts, like in the education committee. Do not talk to anyone in housing.
No, what was the word?
If they hear there's money floating around. But this we are looking at in some way to help with education, so, we will see where it goes. Thank you. Okay,